All right, what's going on, everyone? Someone give me a little note if you can hear me and see me okay. Most importantly, hear me and see the screen. Somebody give me a quick answer. Okay, all right, thank you, Jason. All right, good, good. Let's get started here. Really quick today, I want to talk about a couple of things, and it's a little bit of review of what we've been talking about, but I think it's important right now. One, a number of the stocks that I like right now have the higher prices. Now, that doesn't mean they're more expensive in terms of how you quantify expense, but in terms of position sizing and your account size, a $1,200 stock sometimes can be tough. Obviously, go lower on the shares. We'll talk about in a second. But so I want to review again calls and bull call spreads and how you can make it cheaper for yourself if you understand options a little bit. So do a quick review of that. And remember, we're building a good base of topics just through these pop-up sessions, and you can go up on the pop-up stage. I still have to pop-up page. I still have to do catch up on 1 through 12 here, but at least 13 on. We've already got a lot of different topics we've been talking about here. So make sure to go there. And whenever I update the Focus 40, the updated list is here. It's still updated to a couple of weeks ago because I haven't added yet. I have subtracted. You guys know this from yesterday. About 9 different stocks that I took out as that was probably the biggest updater in terms of just stocks we've taken out because the momentum arena has become so volatile now that some stocks are kind of falling by the wayside and some other ones look better. So I'll probably add 5 or 6 today or tomorrow, and then I will update this link here. Let's go ahead and go over what we're going to talk about today. Again, we're going to go over a little bit of options. And I am going to be in September doing an options class, and you guys will get information on that. I'm getting so many questions about options. It seems like a lot of you guys are interested in options. So obviously, it'll be related to our swing traded and just swing trading and stuff that's just specific to that. And I also want to review earnings. We're in the thick of earnings season now. The big tech and the banks are out of the way. A lot of them stocks are reporting or have reported. And even the ones that have already reported, they're in play now. We are waiting a week or two after earnings to get our good setups for a lot of these stocks. So I quickly want to review the earning charts, and almost all of the big techs outside of NVIDIA have reported. So let's quickly review those. And if you guys have any questions, think about it right now, and you can post them as we're going, so you don't forget. But post your questions here. I think the last couple I didn't do Q&A. So if you guys have any questions, something on your mind or something you want to talk about, a setup, something you're seeing in the market, just post it here and we'll go over it. All right. Let's start with even though I have number 1 on earnings, let's start with the Netflix trade and go over the multiple ways in how we know that we could trade it. We have, the normal swing, you buy your shares and enter your position, very simple and basic. And that's what most of us are doing. You can also try option strategies. One is just buying calls, and 2 is doing a spread. Now, there are a number of different spreads, and I have not gone over all of them with you guys. I want to keep it basic and easy for you guys. So I've just gone over the bull call debit spread. There are other credit spreads and other types of spreads you can do as well. But we're focusing on this just to keep it easy when we discuss these things for now. Now, remember that anytime you trade options, there is obviously a reason you are trading the option rather than just a normal, buying your 50, 100,000 shares, whatever you're going to do. And the main reason a lot of us do it is because of leverage, and it's cheaper to do. So that is essentially, there are other advantages, but for now, that is the advantage for us. And also we can limit our risk with the call spreads. So that's essentially the advantage. But remember this with options. Every advantage you get, there is always a disadvantage. And the disadvantage with doing this, so that's the advantage compared to what we normally do, buying our shares. But again, there is a disadvantage. One disadvantage is there is an end date, right? Wherever your your contract ends, the trade is over. You only have that much time. So if we expect Netflix, since we're looking at Netflix, we expect it to go up to this range here, we have as much time as we need. Not that we're going to take all that time. We can get out of the trade, right? But the point being, it could be 2 weeks from now and it wouldn't matter. It could be a month from now. It could be 2 months from now. We don't have an end date. We just can keep holding and we're not stuck, right? If this thing is down at, pulls back and is down at 1200 instead of 1222, we can hold on and not take the loss, right? So we don't have to worry about time in that regard in terms of an end date. And then time is also not only the end date, but time is hurting us on a daily basis, the theta. If we're thinking of terms of Greeks, we are losing a certain amount of money every day we hold the stock, and we can calculate that. And so we might be, if we look at Netflix right now, if we had one contract which controls 100 shares of Netflix, let's say we go about 30 days out. So let's go to September 19th, a little more than 30 days. At the money would be right around 1223. I don't have Netflix up. If I pull up Netflix here, and let's go back to 30 days out, 31 days here, right around 1223, we'll say 12, 20. Notice here, it's going to cost us 38.95, so we can multiply that up by 100. So we can also already see it's going to be cheaper. And if you can look over at your theta, right here is 0.64, and you can multiply that by 100. So essentially, we're going to lose $64 a day, and that doesn't sound like a lot on a $1,200 stock, but so we have what was the theta again? 64. So 0.64 times 100, we are losing $64 a day, right? And the thing is going to cost us 38.95, so let's just say $39 times 100. It's going to cost us $3,900 to enter one contract. Obviously, you could enter more contracts, but let's say we're just entering one contract. It's going to cost us $3,900. We're going to lose $64 a day. For a $3,900 position, 64 doesn't sound like a lot, but in 10 days, you've lost $640, right? So if the stock has not moved, you have lost $640. So your 3,900 is now down to 32 something, right? Just by sitting there and holding. That doesn't happen when we're holding stock. Stock doesn't move outside of commission if you have commission fees. Outside of that, you haven't lost any money. But with the option contract, you're losing every day you're holding. So you need your price to get over what would be the break even, right? Getting over your theta. So notice here, let's say now we enter Netflix, and we're just to keep it simple, we're going to go at the money. We can go out of the money, in the money, and it gets more expensive or cheaper. We're just going to go at the money, right? As close to the 1223 as we can. Okay. So we're going to take Netflix here. Let's go a little more than 30 days out. Let's say September 12th. So we are at the money here. It's already kind of automatically done that here for us. 1220 call. Okay. Now notice here, you see where the green is and where the red is. Now notice here, the first thing I always do is look at the end expiration date and what is my break even. It's giving us that right here above 1263.75. So what that is saying is at the end here on the 19th, your break even is 1263. We're entering at 1223. So the stock has to go up 40 points just for us to break even if we buy the call and we are holding to expiration. Okay. And then above that, you just keep making money, right? If it goes up to 1313, we've made 49.25. That's quite a bit. That's over 100% move, right? Because it only cost us 3,900. Well, this price they have here, it cost us 43.75. So we've got over 100% gain if it goes to 1313. And our target here is 1350. Let's actually make this a little bigger so we can see all the prices there. Okay. All right, and that's in a little more than 30 days. But that's the break even at the end because you're losing theta every day. Notice your break even is less early on, right? If you look at the 20th, our break even is probably here around 1230 and so on here. So when you enter a call, you want that stock to move very quickly. So you can already see the advantages and disadvantages of doing this, right? One, it's a lot cheaper. So if I want to control, whoops, let me get back here. If I want to control 100 shares, of Netflix, it's going to cost me over $100,000, right? 1223 times 100 shares. If I'm just buying 100 shares, it's going to cost me $122,000. Or my position size is, so I have to have a pretty big account, right? To do that. And normally, let's say you get $50,000 account, maybe you buy 20 or 30 shares. And that can be fine. If you hit your target, you make enough money, that's fine. But what happens a lot of times, you're getting a good profit, but it just takes up too big of a chunk of your account. So it becomes tough to do. You can only enter one or two positions. You might want to enter five. So then you can look to the options. And again, here we can buy the call. And again, you see the advantages and the disadvantage. Instead of costing me 122,000, now to control 100 shares, it only costs me 43.75. And I can make quite a bit if I hit my target in that time period. If we are right now targeting about 13, let's see, where's the top of the range here? We're targeting around 1330. So if this stock hit 1330, notice here, look how much I can make on just a $4,300 position. If it happened very quickly, let's say it happened in the next 5 days, I would make about $8,000 on a $4,000 position, right? 2,200% move. And you can see if I waited till the expiration date, it would be 7,300. If I only got to here at about 1280, I still make quite a bit. I make 3,000 on a 4,300 position. So these huge percentage gains, right? And that is the big advantage. But again, the disadvantage, if you don't hit that, you have a very high break even. I could, the stock could go up to 1250 and I end up losing $1,300. Whereas if I just had shares, I'd be making money, right? So that's the theta. That's the thing that really can kill you on an options, on buying a call. Okay, so these are the advantages and the disadvantages. And notice here, if you go to different strike dates, it impacts. Notice here, if I go way out to October 17th, I even have a higher break even, right? If I make it closer, I have a lower break even. But remember, you're paying for that. It got cheaper. It went from 43. If I go closer, it went from 4,300 to 3,300. It became even cheaper for me. But there's a reason for that. I have less time, right? So it has to hit my targets quicker. If I go out more, it's costing me more, but I have more time for the trade to work on me. And for most of my swings, the sweet spot is somewhere between 30 to 45 days, even 30 to 60 days. And remember, the longer you give yourself, the more expensive it's going to be, but sometimes that expense can be worth it. So that's buying the call. Now, we see some of the inherent problems. The other problem is the risk, right? I can lose the most you can lose. Your risk is capped to the position size. So the most I can lose is 4,300 here, which is nice. If I bought 100 shares, I could lose a lot more if it gapped down big, right? Here, no matter what it gaps down, the most I could lose is 4,300, but that's still a lot. And here, if it only goes down a little bit, I've lost 1,600, 1,700, and so on. So we can make this cheaper, give ourselves a better break even, and cap our risk by doing one of these spreads. That's what's so attractive about these spreads, especially for smaller accounts. And that's why I really recommend smaller accounts learn how to do bulk call spreads. Use our same swing analysis. So you learn the swing, understand the swing, but then do this options strategy. And we'll see the difference here. And let's just keep some notes here. So if we bought 100 shares, buy 100 shares, that was going to cost us around $122,000, right? And let's say the stock went up to our target, which is 13, let's say 100 points. So in that case, we make on 122,000, we would make $10,000, right? Is that correct? Let me just make sure. 100, if it goes, well, no, actually, it goes up 100 points and we have 100 shares. Yeah, $10,000. So we could make, if it hits that 12, no, what was it? We're at 1220. If it hits 1320, we make, so let's say 100 shares at 120. That was our entry price. It costs us in position size $122,000. If it hits our target, one, let's see, what were we saying? 1320. Okay, 1320 target. then we make $10,000, right? And I don't know if someone could calculate that percentage gain, that would be nice on too. Uh, I think that's well, someone calculate that. My brain's not working right now. Now the bull call spread, 1 month out is going to cost us 43.25. So we already see that advantage. Position size. If I have a $10,000 account, I can, take two or three positions. If I have a $30,000 account, I can build up a lot of positions where I couldn't do a lot with Netflix with those size accounts, right? So it's only going to cost me that much. Let's say now we hit that 1320 target. So here's 1320, and let's just go all the way to expiration. So we make 59.29, right? So we're making half, controlling 100 shares. Uh, Hit the target. What it was 50, around 5,900. 5,900. We make less. Instead of 10,000, we make 5,900. But that's $5,900 off only a 43.25 position. So this is, a plus 100 percent gain versus 100, like something like 10%, right? Versus a 10% gain. So you can see already the advantages. Again, the disadvantage though is our break even at expiration. And again, that might not impact you if you're not holding all the way to expiration. Your break even's less, but let's just make it easy and say to expiration. Our break even is 1263, right? So uh, we have a break even is 1263. So you can already see some of the changes in our thought process when we're doing the regular trading versus the book call. We have to be aware of the break even. We need a catalyst to really, I have to know that this stock has potential to move in the next 30 days where I want it to. And then we know our potential gain. And then I can also look at it and say, I'm going to get out if it hits a dollar loss, right? Like maybe no matter what, it's at 1220, but if I'm losing $1,000, I'm just going to get out, right? You can do that because you don't want to lose the whole 43.75. So that is the bull call. Now let's compare that to if we do a spread. So here is a bull call spread. And now with this one, there are multiple ways you can create this. What they've done, and what you're going to be doing is you're going to be buying a call, just like you bought a call, but then you are also going to sell a call at a higher price. Okay. And what that is going to do, it's going to make it cheaper. For one, the way they have automatically created it here. Remember, it was 4,300 to buy the call because you're selling a call against the buy and getting that credit. It's becoming cheaper for you. Now instead of 4,300, it is 3,425. So it's almost $1,000 less the way it's been created here. And notice here, the break even has lowered as well. It's 1254. It was 1263. And it even has more of an impact early on. Okay. So what we're going to do is create a floor and a ceiling. The lower we go on the floor, notice the more expensive it gets, but it's giving you more room. Now notice when I lower the floor here from 1220 to uh, lower, my break even is also lowering, but it's costing me more to do. So again, always an advantage or disadvantage. I lowered the floor here by buying the call at a lower strike. That made it more expensive, but it gave me a better break even. So let's stocks at 12, let's just say we put it at 1200. That is our floor. And we're going up to 1330. So we'll make 13, let's say we make 1340 our ceiling. So what we're doing now, we're capping our risk and we're capping our target as well, or our reward. So when you do one of these bulk call spreads, not only do you cap your risk, you also cap your reward. So make sure you have a spot that you're going to get out to and your reward can hit that spot. Because if it goes above that level, you don't make any more money. It'll be capped at that reward level as well, which is different from the book call. If it keeps going up and you're holding it, you'll keep making more money. But we know here we expect to get out by 1340 anyway, so we can cap it at 1340. So remember, your sell call caps your reward. So you want to know where you think the stock can go to, and your buy call caps your risk. So think of that as like your stop level. Where do you want your stop level to be on it? So we can again, you can create it multiple ways. Generally, your buy call, you don't want it to be high more than at the money. So here we'd be starting at 1220 and we could go lower. And again, notice the impact here on your trade. Now at 1220, we've capped our risk down to 3,700. And as we go lower here, we create a higher risk, but we're also creating a higher reward and a better break even. So let's just keep it at 1,200. The most we can lose now is 4,800 on it. And then the lower we go on our reward, the better our risk gets as well. But we'll keep this at 1330. And that is your bull call spread on this as well. So you can see the benefits and the benefits of both the and I'm not going to write we kind of went over the bull call spread. I'm not going to write it down here, but you can see the benefits and the disadvantages of each of these things. I would lean towards the bull call spreads over the bull calls, but you can do bull calls, especially when implied volatility is low. And we would have to take a lot of time to get into what implied volatility is and its impact, but it's one of the factors in options pricing. When you are a buyer, you want implied volatility to be low because that means your option is cheaper. So remember that. Always buy at low implied volatility. So if we look at Netflix here, you can go on a site like Market Chameleon here, and there are tons of sites, and your broker will have implied volatility as well. But notice here, it gives you a 30-day implied volatility of 24. Look at the IV rank because these numbers are subjective to the stock. 24 could be high on one stock, low in another stock. Look at the IV rank. It's only 9%, which means subdued or low. And you can also compare it to the historic volatility. This is the historic volatility of Netflix. So notice here, just look at the chart. You can see we're at a low level of implied volatility. Recently, we were at a higher level here. And at this point, you wouldn't want to be a buyer. At this point, you wouldn't want to be a buyer. And also notice here, implied volatility tends to increase when you get close to earnings because there's an expectation of volatility around earnings. There was earnings here, and for a couple of months, we had high implied volatility. Same thing here, same thing here, and same thing here. And then it drops after earnings. So we're at a spot where you could, decent spot to buy calls. If we're at high implied volatility, it's a good thing. It's usually a good thing not to buy calls, do a spread instead, because the options premiums are expensive at that level. Okay, so we have a general idea of how we can make these things cheaper. So if you in the swing report, if you see me, getting into a $1,200 stock like this, and you're like, man, I have a $10,000 account, I can only buy 3 shares, and it's going to take up my entire account. I don't want to do that. It sucks that I can't trade this. You can, if you get well versed in these option strategies, and you can play it smart, limit your risk, and limit your position size by doing one of these bull call spreads or a call. And if you have any questions about that, you can ask in the chat as well if you're interested in one of those stocks. And again, I'm going to be doing a class in September related to, it's not a pure options class, it's going to be swing and options. So basically, a swing class and how you can use options with your swing strategies. Okay, so that gives you a general idea. And go back also, we've talked about this a lot. Those of you who are newer and haven't seen some of the past pop-up sessions, go to this page here, and I'll post it in the chat later. I post it once or twice a week. But you have all the pop-up sessions, and here I have listed. So if you want to know, okay, when has he gone over bull call spreads? You can see here in 14, 15, 16, 20, 21, and now 24. I've gone over them, and you can watch those videos. And by the time you've gone over this, you'll have a really good understanding of bull call spreads and buying calls in 16, 17, and of course now in 24. So go ahead and do that if you haven't already, if you're interested in getting a little more well-versed in this stuff. All right, that's the options part of what we're going to talk about here. And it's mostly for you guys who want to make these things cheaper and are having a tough time trading these higher priced stocks. And then now let's talk about earnings. I'm just going to do a quickie kind of drawing, some ugly drawings of the gap ups and the gap downs and some of the setups we are looking at once we get the breakout. So, you have a stock that's been doing whatever it's been doing. Here's the candle prior to the earnings breakout. And then you have the earnings breakout, right? And there are a number of setups we're looking for. One is kind of the high type flag breakout. That's when it either consolidates near the top of the range, or maybe it runs a little and then starts a consolidation. And then you're basically looking for when it breaks that range. Very simple. Doesn't really pull back much. So that would be the high type flag breakout. The other thing is the pullbacks, and we're generally looking at a pullback to one of three places. That is to the 9 EMA, wherever that is. Sometimes it's a little in the gap, sometimes it's a little higher up here. But if it finds support at the 9 EMA, that is a pullback entry. Or another spot where we often see is at the bottom of the breakout bar. And maybe it violates it a little bit, but if you see a remount or just test that level. And remember, the key to these pullbacks is you want to see a little bit of show of strength. Then you can put your stop under the range and then target the top of the range. And if it breaks that top of the range and you get out, you can get back in if it breaks that range. So that's essentially high type flag, pullback, and sometimes you get a deeper pullback into the gap all the way to where it broke out from. It's not an automatic. If you buy here, sometimes it'll just fail and break right through. But again, if it shows strength at that level, this is a very good setup as well, and you can enter here. So that's it. That's essentially what we're looking for on these breakouts. There's some short setups too, but we're not really focused on that right now. And then we have the gap downs, and I think we went over this recently, but it doesn't hurt to review since we're in the middle of earnings season. With the gap downs, remember, we're looking for stocks that have been strong and then gap down on earnings, which tend to be overreactions. So we're looking for those reversals. Sometimes you get an immediate reversal, and then you can enter right away. If it pulls into the gap on the second or third day, you can enter right away. I always target 2 to 1. If I'm holding, I will always get out by the time it gets to this level, because that gap fill can be very strong resistance. Sometimes they'll consolidate for a while, sometimes they'll completely fail. The opposite of that is when it continues down, and then we either look for a strong reversal candle or a remount of the 9 EMA, which will be trailing like this. And that is the continuation reversal. Medium between the two, sometimes it doesn't immediately reverse, but it just consolidates for a while. And then your entry is the same thing when it breaks back as this one, when it breaks into the gap. Now, sometimes your continuation reversals will come up to here, and then you get out, and then it essentially becomes this setup here. And then when it pulls into the gap, you get back in. So 1, 2, 3, and whoops, and then 4 is, oh, something's happening. Something's happened here. I don't know. Let me start this over. And then 4 is when we get back up to here. I said this is the part we get out, and we get a little consolidation, and we break this gap fill. That is a very strong setup, obviously. You're basically invalidating all this bad news, and then the stock gets back on trend. And for this to happen, 1, 2, or 3, or a combination of these has to have happened, right? So oftentimes you'll have traded it as one of these, and then it breaks through here, and then you can get in again. And we've seen some good examples of that recently. And we're essentially trading gap down reversal on Netflix right now, right? And it's getting close to getting back on trend. So those are essentially this is the quickie version. Obviously, there's some more depth to it, but this is just if you want to have a general idea of the things we're looking at for these breakouts that we're tracking. That's it. The 4 gap down setups, and then 3 or 4 of the gap up setups there. And we have our list here. And what I would be doing is I'd be keeping my breakouts list for this quarter, and every day going through them and seeing what is setting up, right? So here, SMCI is a gap down. Right now, we'd be watching this for a 3, right? It's essentially gap down and just consolidating. And now we're waiting to see, does it pull into the gap? And then we would have a potential entry. Road was a gap up. It's continuing higher, nothing to really do with it now. But if it started to consolidate here and broke, we would have the high type flag. SBH today is kind of like breaking a high type flag here, right around 1223. Spotify was a gap down. Notice here we had to pull into the gap. That would have been your entry. And now here we're watching for it to close above the gap fill, and that would be our setup number 4 here, and so on. And that's what you do on a daily basis. You're looking for those potential entries. Ring, maybe this is the pullback play. It's holding the 9 EMA. This could be a potential breakout pullback. RL, we're watching for the gap fill here, right? If it fills that gap, that would be setup number 4 on the gap down setup. ELF already has done the reversal and triggered the gap reversal. Notice almost all of these gap downs that we're looking at reverse, right? That's why I love this setup. They tend to be these gap downs on earnings tend to be overreactions, and a lot of these reverse. Now, I wouldn't just guess, but you want to see some evidence that it's going to do that and trade these. That's why we trade these setups. All right, that's essentially what I wanted to cover with you guys today. So we went over it quickly, but it's a lot, right? There's essentially 7 setups here related to earnings: the 4 gap downs, the 3 gap ups, actually 4 gap ups because all the way to the gap fill as well. And then, of course, the bull call spreads and the calls. It's simple to describe, but it gets very intricate. And when you actually get into doing it. All right, so that's what I wanted to cover. If you guys have any questions, I don't see any questions so far. But if you have any questions, let me know. Brent says I let the option strat website optimize for me based on my that site I was showing you guys, option strat, makes it very easy to visualize your profitability here, so you don't have to calculate everything. Or there's those line charts as well, and I like to look at it this way, much better. And your broker usually has the kind of line profitability charts. I like to go here, and it's not maybe exact, but it gives you a general good idea. Joy's asking, what does showing strength look like at key levels? Good. Yeah. So I basically think of it as like a pivot. So when it's pulling back to a support, whatever, whether it's a trend pullback or a breakout pullback, I like to see. Otherwise, you're just guessing, and you've seen this probably many times. It just blow right through that support level, right? So I want evidence that the support level is holding. So let's say we have our pullback, right? And here we're looking at the bottom of the breakout bar. You know, it's pulling back, it's pulling back, it's pulling back, and it's at that level right now. I basically want to see a pivot. So the next day, I want to see a strong candle there. And you can look at formal candle patterns. I don't tend to look at it that way. I just want to see some bounce at that level, showing me that there is strength. Okay, Nicola is asking, if a stock goes up, do you think the take profit should be placed on the level of the 9 EMA if it reaches initial take profit? I'm not understanding your question, Nicola. Either re-ask it here or re-ask it in the chat, but I think you're gonna have to word it a little differently. I'm not quite sure what you're asking. Um, what about volume? Yeah, on the breakouts, we want to see explosive volume. Generally, on breakout day, I want to see double the average volume. Notice here was CISO. Here's the breakout day. And notice here, the white line is the average 50-day volume, and obviously it's double that. You can just eyeball it and tell. Post breakout, I don't really care as long as there's not distribution volume, big red candles. Otherwise, you're generally going to see a lowering of volume after the breakout day, and that's fine. I just don't want to see big, huge red candles on the post breakout. All right. If you guys don't have any more questions, we'll do another one of these later in the week. What is today? Tuesday. We'll do another one. We'll probably do one on Friday morning. So keep a lookout on that. And then, of course, guys, get active in the chat. I see some of your faces here, names and faces, and I don't see some of you in the chat. Use that chat as a tool to ask me or other members questions, or even just commentary that you think could help others. All right. Talk to you guys soon.